Welcome back to another episode of Token Narratives. I'm Graham Stone, joined by Alex Richardson, and today's episode of Token Narratives is brought to you by Real.Finance. We'll be speaking with Chief Business Development Officer at Real.Finance, Pauli Speaks, in the second half of the show. Looking forward to that. But first, let's get into a little markets update. So, stocks, starting off with stocks. The stock market continues ripping everyone's face off. All-time highs still on, once again, on stocks, led as it has been for the last year, more and more, by AI. Precious metals, once the darling of macro traders, have fallen into a deeper slump, deeper correction, I guess. Gold was trading as low as 4,500, backed up a little bit, 4,570. Oil surged back higher, above 110 briefly, has pulled back somewhat, now at 105. This is on the back of continuing uncertainty in the Iran region, the Strait of Hormuz. All the chaos coming out of there. One day it's war on, one day it's open, one day it's closed. Oil's telling us right now that it's more closed than it was a few days ago. In the US, prices at the pump are surging, I think up 30% on the year, from a low of under $3 per gallon. Who uses gallons? To
I don't know what that means.
Over, I'm not sure. It's 4 liters about over $4 per gallon, straight up in the last month or so. As they say, there's nothing better. There's more surefire way to lose an election than to have gas prices at the pump be high. So I don't know. Maybe they want to lose.
That'll be a 1,000 IQ move.
All right, let's get into some of the top crypto analysts and prognosticators, what they've been saying over the last week or so, starting off with Rekt Capital. Alex, can you explain what Rekt Capital has to say? He says bear market progress 56.5%.
Yeah, so he's taken a really cool-headed approach and just looking at market cycles through time. You can see the blue lines are where the halvings are. It's not at the exact date, but it is the exact month. July 2016, May 2020, April 24. And you can see that even if we wish that the 4-year cycle was not a thing anymore, historically it is a thing and is still playing out now. And just based on this, yeah, he's saying 55% of the way through, meaning that we're 55% of the way through this halving cycle. And it's implying that we got a few more months of downtime in those red squares before we bottom out and hit the next halving cycle.
All right. Seems like the worst of the pain is over. At least
Yeah.
that's how I read this chart.
Same.
Kind of seems like a decent accumulation time. All right. Moving on. We have Fidelity's head of macro, Jurrien Timmer, and he says...
Jurrien Timmer.
I'm sorry.
Come on, it's European. The J is a Y.
It's a European. That's right. I knew a guy in high school, an exchange student from Holland, I believe, and yes, his name was Jurrien.
Yeah.
So he says, if Bitcoin cannot be pulled down by this current combination of overbought momentum and trendline resistance, then this is an emerging bull market and not a bear market rally. Would you be able to unpack that a bit for me? I'm looking at a chart here with looks like sort of 2 legs down after the peak.
Well, he's basically saying that technical analysis 101 means that this is a time to sell. We've got a bear market rally inside of a channel hitting resistance, and usually this would be a perfect time to sell. But he's kind of saying that his hunch is telling him that this could be an emerging bull market and not necessarily a bear market rally. He's one of the few like big conservative TradFi guys that is openly optimistic about Bitcoin and remaining bullish even in the bear market. And he thinks that 60K was the bottom. And if we do make a move lower, it's not going to be significant, according to him.
Yeah, there's been a lot of chatter about this recent rally being a bear market rally, meaning yeah, you hit resistance and then you go back down, kind of like what Rekt Capital was pointing out in the last post. But Timmer saying
Timmer.
no, he thinks this this may not be it may not be a bull market, a bear market rally. So do we know what his invalidation is for this? Is it basically if we don't, are we at a critical moment right now?
Well, based on his chart, it looks like the invalidation would be a break below that line, like the 65 level. And that would, according to this, sort of confirm that it's not an emerging bull market, but it's just a simple, classic TA 101 bear market rally.
Okay.
And otherwise, yeah, a break above the 80K level would sort of validate his thesis that we're at the beginning of a bull market.
Got it. All right, now let's talk about the RHODL metric.
Yeah, so the RHODL metric is suggesting, based on this chart from Bitcoin Munger, that Bitcoin is cheap or near-ish the bottom. And the idea behind the RHODL is that it compares the ratio between old coins and young coins. There's a few different cohorts that you can compare. In this particular chart, he's comparing 6-month to 2-year-old coins to that of the 1-day or 3-month-old coins. So a rising or a high RHODL suggests that the young coins are becoming scarce relative to the mature 6-month to 2-year-old coins. And that often happens after a flush out when coins have aged into stronger hands. So the idea is that the short-term paper-handed cowards are leaving the system, leaving the market, and all what's left are the long-term minded, longer, older coins that are less likely to capitulate and dump the price. And so in that chart, it is sort of suggesting that we're not at the bottom, but these will be historically cheap, just based on the previous spikes.
Right. So looking at the previous spikes, we have these blue spikes. They all sort of correspond with a rally afterwards. There's a spike, and then you have several month move upwards in the period after the spike. And right now we're at a spike that's bigger than the 2019 spike, but not as big as the 2015 and 2022 spikes that preceded those bull runs.
Yeah.
All right. And we got this who is that? Is that who's that guy there in the picture? Is that Peter Brandt?
No, it's Charlie Munger.
It's Charlie Munger.
Warren Buffett's
That's right.
right-hand man. Rest in peace.
Right. Okay. Okay. So moving on. Next guy, Jamie Coutts. Did I get that one pronounced correctly?
Yeah, no, it's Coutts, not Coutts. Yeah, so he's sort of taking a more conservative stance here and just acknowledging that a 25 to 30% counter trend move is very typical in every Bitcoin bear trend. And of course, once we hit resistance at 80K, That was a pretty classic critical on-chain level. That's the true mean price. And the true mean price is the what is the true mean price? It's the average acquisition of on-chain coins by investors, and thus likely like a reference point for mean reversion, similar to like cost basis. Um, and of course, yeah, price
Yeah.
has definitely reacted to that 80K level.
Yeah, and
So another argument
a
for
lot of
the
people have,
bear market rally.
right, and a lot of people have been pointing out that around the 80K level is um, where a lot of there has been that's where a lot of trading has happened over the last several months, and that means that that supports the idea that it's a critical level.
Right.
So Jamie Coutts basically saying we're likely to bounce off this and have a few more months of pain.
Yep.
Okay. So next up, we have some data from Glassnode about trading volume. So the Bitcoin spot volumes across major exchanges have fallen to their lowest levels since October 23rd. So all the way back here at the start of this chart that I've got up on the screen, we are trading the volume that we have right now has not been that low since October 23rd. And these low volume environments, Glassnode notes, often coincide with reduced market depth and heightened sensitivity to flow shifts. What does that mean?
Yes. Well, it just means that the liquidity is thin. So whenever there's a new flow of capital, it can really move the price in either direction, basically. It's not necessarily a bullish or bearish. It just means that whatever happens next could be really extreme. We could see some volatility.
Okay, so we're likely to see big move in either direction sometime
Yeah,
soon.
inflection point.
If right. Okay. Next up, Paul Tudor Jones. Where's Paul Tudor Jones? I'll bring up his.
Yeah, he said in an interview
Oh, there it
with,
is. Patrick
I want to say
O'Shaughnessy.
Paul, yeah, Patrick O'Shaughnessy, that Bitcoin is the best inflation hedge, better than gold. More than gold because Bitcoin is finite. There's only so much Bitcoin that can be mined. Um, he brings up that there are some problems with it, like if there's ever cyber warfare or something that you have to deal with electronically, Bitcoin's going to be going down. There's also the quantum computing threat, but who knows when that comes to fruition. But he just says, in terms of it being a great inflation hedge, gold is increasing in supply every year by a couple of percent, where obviously Bitcoin is finite and only a certain amount can be mined. It's also decentralized, so that's pretty nice. Paul Tudor Jones is a iconic American investor. He founded Tudor Investment Corporation in the 1980s, and when he talks, people listen. So that's kind of cool that he came out and said that.
Yeah, and saying basically what all Bitcoiners say have always said that
Yeah.
yeah, Bitcoin is scarcer than gold. However, in the interview, he does point out some downsides to Bitcoin. So he says if you've got a kinetic exchange, there's clearly going to be cyber warfare, and anything you have to deal with electronically is going down, including Bitcoin. So that's strike one. And then he also points to quantum computing. If and when with AI advancing as fast as it is, that we may actually have quantum computing. Now, quantum computing could come in and hack anything they want to. So, in terms of it being a great inflation hedge, gold is increasing in supply every year by a couple of percent. There's a finite amount that can be mined. It's decentralized, so in that sense, it does have the greatest scarcity of anything. But he did point out a couple of downsides with the Bitcoin thesis. So, all right, any thoughts from your gut? What's your gut check telling you right now?
Gut check. Well, as much as I hate bears, and as much as I'd be heartbroken if my children grew up to identify as bears, did you think this is a pretty decent time to be bearish right now, or at least cautious? I know it's like a cliche finfluencer kind of thing to say, but it does sort of feel like we're at the edge of an inflection point. A couple of months ago, when things were first getting intense in Iran and oil was rallying and the implications of the closure of Hormuz became clear, like a lot of people, including myself, were saying that it kind of felt like February 2020, that pre-COVID lockdown period where everyone's sort of in denial about how much damage was about to be done to markets. But now that stocks are at all-time highs and like earnings are strong, nothing really happened. Everyone who made that comparison kind of looks like a doomer, and all of the panic before just looks like it was like a scam so that the goblins could buy the dip. But I kind of disagree. It's like nothing's really fundamentally changed since then. And if you look at the charts, the S&P and the Nasdaq both hit all-time highs in February 2020, like right before COVID, while COVID was in the headlines. And then instantly, like a couple of weeks later, 3 or 4 weeks later, they were down like bigly, 30, 40%. Similarly, Bitcoin was in the middle of a relief rally. It topped out at 10K, flash crash to 3K. So there is some parallels, I think. I don't know if it's as extreme as March 2020, but the fact that markets are pricing in a resolution, that doesn't really mean anything to me because they could just easily price in another scenario next week. You still have like Asia's facing the worst oil crisis in history. Europe apparently just has a few weeks of jet fuel left. And there's just all these like macro alarm bells. If you look at things like commercial and industrial loans in the States, private credit, consumer debt, all-time highs, credit card debt, all-time highs, housing unaffordability. We got a new Fed chair coming in this month, which usually results in stock market corrections. So I don't know. It feels like there should be some sort of economic downturn. And also, if you believe in the big print thesis, or that QE is going to be a big catalyst for Bitcoin, like Arthur Hayes does, then I think you should also believe, in my opinion, that the Fed will need some kind of justification for it. Like before it was COVID, in 2014 and 2016 it was unemployment. Before that it was the GFC in 2008. So I think this time they've got a perfect excuse. They'll say, "Oh, like it's the Iranians' fault. It's the Iranians' fault that we had to print money and destroy the middle class. It's the Strait of Hormuz crisis." So, anyways, that's my base case.
Yeah.
Is Bitcoin risk assets do a little dip, and then we're off to 200K later in the year.
Yeah, actually, I pretty much fully agree with that. I think I've been starting to feel more and more FOMO about TradFi stocks, and I know that when I feel that, that means it's probably the top. So I've been doing my best to not give into to the FOMO and try to like invest in Nvidia or whatever it is. And yeah, I think that's probably what's going to happen. We're going to get a pretty big pullback in the stock market, and then that will be the trigger, as you say, for some kind of big print, and Bitcoin will get hit in the downturn. I don't know how badly, probably not as bad as in the past, but I wouldn't be surprised if it does go down to like even below 50K. But it will rise from the ashes faster than everyone else. I think.
Yeah, it'll be the slingshot.
Yeah.
It's definitely humiliating when TradFi outperforms crypto for this long, but I think we're probably reaching peak humiliation. Like it can't get much worse.
All right, let's get into our next big topic for this week's episode of Token Narratives: the rise of DATs and the art of Tom Lee's mental illness. This is from our docket notes that you wrote, Alex. I like the title. All right, take us through some of the
flattering way.
Yeah. Okay, take us through some of the stats you've got here.
Yeah, so yeah, obviously there's a lot of talk about whether the bottom's in, whether it's a bear market rally like we just discussed, or a beginning of a new bull cycle. There's obviously not a consensus, but one group of entities that apparently think this is a fantastic buying opportunity is the digital asset treasuries, the DATs. Everyone knows that Michael Saylor is a big fan of the corn. He thinks it's a swarm of cyber hornets serving the goddess of wisdom. And Strategy started the year with 672,000 BTC, and now it has 818,000. So they've added about $11 billion worth of Bitcoin to its treasury, which is about a 22% increase in 4 months, which is obviously quite aggressive. And in the last year, MetaPlanet has gone from 5,000 coins to 40,000. That's an 8x increase. You can go down the list of all the Bitcoin treasuries: Strive, Block, American Bitcoin. Most of them are either buying or at least not selling their coins. Like there are some exceptions, but for the most part, these Bitcoin DATs are getting very aggressive and optimistic. And then, of course, you have the rise of the Ethereum DATs. Tom Lee is the most prominent here. Bitmine Immersion currently owns over 5 million ETH, valued at around 11.75 billion. And even though he's down $6.5 billion in unrealized losses, the company just keeps ramping up its ETH purchases, especially in the last month or so. Roughly every week, Bitmine announces a new ETH purchase. Last month, it was like around 60,000, then it grew to 70,000 per week. And for the last 2 weeks, it's been over 100,000 ETH. We'll see what they announce next week. I'm pretty sure the on-chain stuff is showing that they're still accumulating later this week. And at time of recording, Bitmine owns more than 4.21% of the total ETH supply of 120.7 million, which means Bitmine is 84% of the way there to achieving its alchemy of 5% in just 10 months. And other than the beacon staking contract on Ethereum, Bitmine is by far the biggest holder of ETH. They also announced in March the launch of Maven, which stands for Made in America Validator Network, which is its own proprietary staking solution, which is also now the world's largest single staking operator. So they got $14 billion worth of ETH staked there. So they're the largest ETH holder. They're staking the majority of their ETH with their own staking provider, which is the biggest in the world. And they're earning about $300 million in staking rewards annually. And that is one of the advantages of a DAT, that a DAT has over an ETF, because DATs can earn staking rewards and then do various things with that yield. So far, Bitmine has just been reinvesting most of that ETH, but you're already seeing Bitmine invest in various other beta plays that like kind of vaguely relate to its Ethereum thesis. Like for example, earlier this year, Bitmine just casually announced that it invested 200 million in Mr. Beast, with this idea that Mr. Beast is getting ready to sell financial products to his audience, like student loans and insurance, credit insights, and other things sort of geared towards young people. And Lee wants Ethereum to be the rails, basically. Mr. Beast has a massive amount of reach. And if his audience is going to be using these on-chain financial products, then Lee wants to make sure that it's going to benefit his ETH bags. So he's like really thought all of this through, and it might be one of the biggest gambles of all time. Like maybe not by dollar amount, obviously, but just like the sheer risk and the concentration of risk and the amount of unknowns. It's pretty amazing to see. I don't know. Do you think he's mentally ill, or is he onto something here?
I'll save my opinions for after I go into a little bit more about what Tom Lee actually thinks is going to happen, right? So Tom Lee thinks ETH is going to $62,000 per ETH. So that's what, 15x, 25x. I think from here we're trading around $2,000 per ETH, and he thinks that that's his price target, because Wall Street will begin innovating on the blockchain and put many new financial products on chain, like tokenized credit, tokenized real estate, money market funds, stable coins, etc. And it will ultimately be built on Ethereum. He laid all this out at a presentation at Paris Blockchain Week. Did you meet him when you were there, by the way, Alex?
No, I missed him. I was hoping to see him, but I missed him. I was busy.
Yeah, I would have been good to catch a glimpse of his aura. I always like to see what these figures look like in real life. Anyway, uh, Lee said currently is going through a massive consolidation that will resolve in a very big move, and it'll be driven by two things: tokenization, and the other is agentic AI. So he says, quote, I think we're going through an important moment in the financial system, not too different than 1971, which is that tokenization is at a time when we're making almost every asset synthetic, and it follows a roadmap that happens when the US went off the gold standard in 1971. It went on to unleash a huge innovation of products from money market funds to currency futures to CDOs, index futures, all because the US was trying to preserve the sovereignty of the dollar. And we went off the gold standard. Well, I think that's happening today because we're digitizing everything. So that's his theory. You can see this insane price target. All right. Now, what do I think? I think it's totally wrong. Um, I don't think that institutions are building on Ethereum. They're building on permission chains like the Corpo chains, Tempo, Canton, etc. And even if they did build on Ethereum, that doesn't help the price of ETH because you don't need ETH to build on Ethereum or use Ethereum. You just need like a couple of dollars worth of ETH. And the whole the whole structure of all of these smart contract platforms, and we've seen this play out, is it's a race to zero in terms of the fees generated, right? Solana fees on Solana are like a fraction of a cent, and Ethereum had to compete, and so they started scaling on the layer one. Layer twos are even cheaper. The blockchains themselves don't make money when people use them. So I just fail to see how uh, it could reach $60,000 per ETH, which I think would be like a significant percentage of all global wealth in the world. Um, it just doesn't make any sense to me. So
Yeah,
I know people
I
push back
definitely
on that,
agree.
but go ahead.
I'm not necessarily like bearish Ethereum, but I don't see how he can be so confident that all of these things are going to happen on Ethereum and not Solana or Avalanche or some other layer one. Or how do we even know they end up on any of those chains and not just like some other centralized permission proprietary chain run by Wall Street?
Exactly.
And also like when you invest in, like if you invest in Bitcoin, you're investing in one asset and one narrative basically. But with Ethereum, like you're investing in many different assets and many different narratives. Like you're betting on tokenized real estate, tokenized credit, equities, NFTs, agentic commerce, on-chain gaming. There's so many questions and so many different moving parts and things that need to play out. I wouldn't be surprised if we do see Ethereum hit 8, 10,000, but before Tom Lee started going crazy, I was kind of not that optimistic on Ethereum just because it's infrastructure. And infrastructure is not really where value accrues compared to the businesses and the apps and where the end users are. Like you could have been correct that internet was going to be the next big thing in the early 2000s, and you could have said, well, I don't really know like which businesses are going to be successful. So I'm going to just buy the picks and shovels. I'm going to buy shares of Verizon because people need internet connections and copper because they're going to need wiring in their house. And those would have been terrible investments compared to just buying like Google and Amazon and Apple. And that's kind of what I see with Ethereum. It's like maybe it's not going to be a terrible investment, but yeah, 60,000, I don't see how it reaches that at all.
Yeah, absolutely. Now, Tom Lee also notes about the risks that Ethereum is facing. I mean, in the last couple month or so here, we've had biggest hacks, the biggest month or so of hacks ever. I think we're at like $600 million in hacks, and they're mostly on. Well, a lot of them are on Ethereum. The entire smart contract landscape is riddled with risks. And Tom Lee says the risks of Ethereum, like smart contract risks, hacks, etc., seem like smaller risks compared to the fragility of the existing financial system. Now, I don't agree with that at all. Uh, it's like way higher risks. If something goes wrong in the existing financial system, the 12 guys in a boardroom just like say like, hey boys, roll it back. Not so in the world of smart contract platforms, where like code is law, and it's extremely difficult to roll things back.
Yeah, I think that Tom Lee's either going to be remembered as the smartest investor of all time, or he's going to be banned from the financial industry and forced to start selling mattresses or supplements or something. I mean, I hope he's successful, but it reminds me of that meme, or how some people say that the key to life is just being delusionally optimistic and walking into every situation like a golden retriever and just refusing to acknowledge the possibility that anything could ever go wrong. That's Tom Lee. Like he's always bullish. He's always optimistic. He could get shot in the knee, and he would show up at CNBC headquarters on crutches and explain how the last time he got shot in the knee, the S&P 500 rallied 10%. Like, and it works. He, he's obviously made a lot of money. His perma-bull mentality has worked. So I think it'd be really amazing if this plays out as well.
Yeah, just good point. So yeah, you got to respect that. All right, we've got a special guest joining us. Pauli Speaks is the Chief Business Development Officer at Real Finance, which is an EVM compatible layer one focused on bridging real world assets fully on chain. And they just went live with their asset token generation event. And we're proud to have Real Finance sponsoring this episode of Token Narratives. Pauli, great to have you with us. Uh-oh. Are you? Can we hear you? Say something. Uh-oh. Uh-oh. You're on mute.
Tap the microphone icon.
All right. Could you, if you can hear us, Pauli, could you just jump off and then try jumping back on? We'll hold the fort.
You want to start beatboxing or something? Provide some filler here. I just noticed that it said Ethereum Bull Run Roadmap for your kids. I don't know if I would be promoting this to children. Bunch of degenerate gamblers.
Bear with us, folks. We're having technical difficulties, but we'll sort this out. All right, she's back.
Okay,
can we hear
guys,
you
can you
this
hear me
time?
now?
Okay, we
Yeah,
got
there
you.
you are. Hi.
All right.
Awesome.
Okay.
Awesome. Hi, everyone. Pleasure to meet you.
Yes.
Quick
Likewise.
addition though. I'm not the chief business developer officer at Real Finance, just a strategic advisor. But yeah, happy to be here.
Sorry about that, Pauli. Strategic advisor at Real Finance, Pauli Speaks. We'll cut that out in post. All right. Tell
Awesome.
us about Real Finance, Pauli. Give us the elevator pitch, and then we'll get
Sure.
into some of the weeds.
Usually, when I'm doing an elevator pitch, it's more than just an elevator pitch, but I will try to keep it short. Basically, what we're doing right now, we're trying to create a larger financial group that consists of regulated financial institutions, sovereign wealth funds, broker dealers, and of which we view ourselves as a fintech. We view ourselves as a technology going beyond that sort of high level summary that I gave you. The technology front, what we're trying to build is a full life cycle tokenization solutions, right? We're purpose built layer one for RWAs. So all the way from the front end, you've got your asset issuer slash owner to the tokenization companies to us as a back end rails, where things get deployed on.
Right. And we've just been talking in the segment before this about a little bit about tokenization and RWAs. Tom Lee from Ethereum believes that that's one of the key things that's going to be driving value in the smart contract space. You guys aren't on Ethereum. You're not Ethereum. You are your own EVM compatible layer one. Could you go into that?
Right.
Why do that? Why is EVM a priority for you?
So basically, when we started building Real Finance, right, we wanted to make sure everyone felt welcome from day one. You can think of EVM as, or like Ethereum virtual machine as a global language, right, of the blockchain world. If you build a beautiful city, but nobody can read the street signs, no one will visit it, right? But by being EVM compatible, we're using the same signs and rules that millions of people already know, and it's like opening kind of a new coffee shop that uses the same loyalty cards as the biggest chain in a town. So developers do not have to learn a whole new way of coding, which saves them a lot of time and a lot of headaches. So they can just copy and paste their favorite tools and apps right onto our network, and it's pretty great for users as well because they can use the same wallets like MetaMask, for example, that they already have on their phones. So we didn't want to reinvent the wheel. We just wanted to build a better road for the wheel to roll on, if I can say it like that. So I think that this compatibility just makes perfect sense and makes us a plug and play solution for the entire crypto community, and it removes this scary part of moving to a new network because everything feels familiar. And in the end, we just chose EVM because we want to grow fast and speaking the most popular language. That is the best way to do that.
Yeah, and
And
um, sorry, just to follow up on this, I've just before you came on, Polly, I was disparaging Ethereum, and one of the reasons I think that Ethereum is not going to make it is because exactly because of what projects like yourself are doing, right? Which is you don't build on Ethereum, you make your own uh, EVM compatible chain, and like why would you run it on Ethereum when you can do it yourself? So sorry, that a bit of an aside there, but it kind of proves the point I'm making. You have more control, and you're not like at the whim of the Ethereum network, but you still are EVM compatible, so it's easy for people to like bridge or make the switch using the
Yeah,
same tools, basically. Yeah.
I mean, it feels like people say don't build on Ethereum. Yeah, you're out here doing exactly that, right? Some of the people. But I think that having more control over your own stack just makes more sense, right? Like relying on a system that keeps changing and has high fees doesn't feel sustainable. Oh gosh, I hope that I'll not get any kind of a hate for that, but you probably just want something more predictable and flexible.
Right.
And Polly, I was wondering, could you explain how the asset token sort of fits into the stack? What's the utility of it beyond just paying for like transaction fees?
Of course. Of course, by the way, our TG went live yesterday, so you can congratulate us. It was not a bad launch, and on our roadmap, there are going to be more exchanges adding to the whole system. So, yeah, we're starting slowly, but in terms of answer to your question, asset token is much more than just a way to pay for your gas on our network. You can think of it like I love doing analogies for people to understand it better. So you can think of it like a multi-purpose tool that keeps the whole real finance machine running smoothly. First, it is a governance token, of course, which means it gives you a voice in how we do things. So if we want to change rule or add a new feature, we get to vote on it, almost like being a member of a club. Second, it's of course used for staking, which is I think that either already live or will be live pretty soon. And it's a way to help keep the network safe and secure. When you stake your tokens, you are basically saying, I believe in this project, and the network rewards you for that trust. It is a bit like putting money in a high interest saving account, but you're also helping to guard the bank itself. So, and at the end, I think that the token is used by the risk scorers and issuers on our platform. So these people have to hold asset tokens to show that they are serious about their jobs. If they do a bad job, they might just lose some of those tokens, which we call slashing. And I think that this ensures that everyone has skin in the game and acts honestly. And it also creates a kind of a natural demand for the token as more people join the ecosystem. So whether you are just voting or securing the network or just holding it, the asset token is the heart of everything that we do.
Got it. And you mentioned that the TGE has been successfully completed, the token generation event. So Asset is now trading on some
Correct.
exchanges. Where?
KuCoin, Maxi or MXC, Kraken, and OK Exposed.
Oh, quite a
Wow.
few of the big ones.
Yeah.
All right. Could you go into the tranching system for assets? Explain what that is in the real finance ecosystem and how that might help a TradFi investor who is new to on-chain finance.
Of course, of course. So, to be honest, talking to TradFi investors is it's a hard game to play, and tranching is a great way to make big, complicated investments feel much safer for someone coming from a traditional world. Imagine you are at a buffet, but instead of food, there are different levels of risk, and some people love spicy food and do not mind if it burns a little, while others want something very mild and safe. And trenching takes a big pool of assets, like a group of real estate loans, or slices them into these different flavors. The senior slice is like the mild food. It gets paid first and it's very safe, but the profit is a bit lower. Then I would say the junior slice is a spicy one. It takes the most risks if things go wrong, but it also gets the biggest rewards if things go well. And for a TradFi investor, this is perfect. It is perfect because they can choose exactly how much risk they want to take. They don't have to worry about this wild west of crypto because they can pick the safest slice available, right? Not to have the digestion problems, and it's like having this safety net under the tightrope walker. Even if some of the loans in the pool fail, the people in the safe slice usually still get their money back. And I think that this structure makes on-chain finance look and feel much more like a professional banking world they are used to. So it turns this scary all or nothing bet into a very smart and organized investment strategy.
Could you walk us through what it looks like with I don't know, an example of a asset or a vault or like a product. And so a user would come in and deposit one asset and get be able to sort of select the tranche that of like the risk profile that they're comfortable with. Is that what we're talking about?
Yes, correct. As you know, we have a risk scoring model, and basically, imagine, okay, 100 million euros, a pool of real estate loans. They got tokenized on chain. And these are mortgages or commercial property loans that generate very steady interest payments. Then, as I explained, this buffet trenching, scenery trench, let's say 70 million, then medium trench 20 million, and junior trench is 10 million. 10 million highest risk, highest returns, let's say 12% plus. Scenery trench is going to be lowest risk and lowest return, which is like 4%, and medium is somewhere in the middle, let's say 7%. So senior is safe and predictable, but junior is kind of risky, but just juicy upside. And let's say a pension fund, a very risk averse one joins. They invest 10 million into the senior tranche because they get paid first, they're protected from initial losses, and it behaves pretty much similarly to investment grade bonds. So this feels just familiar to them, and structured credit already exists in TradFi. And then there will be a cash flow distribution. Now, the loans generate income. Let's say every month, interest payments come in from borrowers. Payments are distributed in order, like senior investors get paid first, then medium ones, then junior ones. What's left? But what happens if things go wrong? Let's say 1 million of euros or like 8 million of euros of loans default. Like, here's how losses are absorbed. So junior tranche takes the first hit, wiped from 10 million. Now it's 2 million left. And medium and senior guys got untouched. So the pension fund in senior is still safe, and only if losses exceeded, like for example 30 million, then senior would start taking some damage. So I hope that makes sense. I tried to
Yeah,
make some
totally.
analogies so it's easier.
Yeah, makes a lot of sense. So you can see how that would be attractive to both risk-averse parties and those looking for, a juicier return,
Correct,
who are willing
correct.
to stomach the risk.
So for a traditional investor, the setups basically mirror structured products like CDOs or IBCs and provides a predictable risk layers. And it removes this crypto chaos by offering just controlled exposure.
Got it.
And Pauli, so obviously stablecoins are emerging as a really important part of the digital asset ecosystem. So naturally, a euro derivative stablecoin is part of the Real.Finance roadmap. Do you want to sort of get into that? Why the focus on the euro specifically? And I guess how is it going to be collateralized? How does it work?
Sure. Well, that's a pretty exciting question, to be honest. I'm waiting for it to be live. So we decided to focus on Euro because as a European company, we want to follow the rules correctly. There are going to be different jurisdictions where we're going to be licensed and legal, but started from Europe, so why not? In the crypto world, almost everything is in US dollars, but there is a huge group of people in Europe who want to use their own currency, and the new MiCA regulations in Europe give us a very, very clear rule book to follow, so which makes everything more stable and legal. And it's like, I don't know, playing a sport where the referee actually explains the rules before the game starts. Of course, it's not perfect yet. I have a lot of debates with different regulators on that, but we're working with what we have. On Euro derivative stablecoin, our euro oh Christ. So that's it. We can close the show. Our stablecoin will be collateralized, which means it is backed by real and valuable things. So we do not just print money out of thin air. Every coin is supported by assets like high quality bonds or cash in the bank. And it's like a gold standard for digital age. If you have one of our euro coins, you know there is something real standing behind in a vault. And this makes it much more reliable than just like algorithmic stable coins that can sometimes disappear overnight. So we're working with partners like Vinor Private Bank to make sure that the backend is pretty transparent and safe. And in 3 to 4 weeks from now, we are launching our pilot where we're gonna tokenize 50 to 100 million on chain from Vinor Private Bank. And by focusing on euro, we're filling a big gap in the market and giving European institutions a tool they can actually trust. It is all about bringing this stability of the old world into the efficiency of the new world.
All right. So sounds like similar to the stablecoin model of U.S. stablecoins like Circle and Tether, where they're backed by the safest assets. So in your case, you're talking bonds or basically cash equivalents, and it's all regulated via MiCA, and the demand, the market seems to be there because a lot of people in Europe would like to have access to a euro version of a stable coin, where
Exactly.
until now it's just all dollars. And then I guess your business model is basically you earn the yield on the assets that are held in custody,
Correct.
just like how Tether and USD Circle work.
Correct.
Okay, but could I ask one more follow up on this one? With stable US dollar stable coins, they of course integrate into DeFi. Are there plans for similar integrations with your euro stablecoin?
I can't say much right now, to be honest, because this is just in a progression, I would say. But I can say that there are some plans. Yes, but carefully. A lot of DeFi today is still like too volatile and unregulated for institutions. So I would say we will go first into controlled environments and use the Euro stablecoin as permissioned DeFi. Lending, repo style markets, collateralized borrowing, then probably we'll go for selective integrations like plug into trusted protocols like Aave or make a DAO like structure, but only where risk is clearly managed. And yeah, later on there's going to be institutional DeFi rails, which is like UAC compliant liquidity pools, but it's not full permission, I would say, for now. It's going to be hybrid.
Okay. Less of a Wild West version, more of the safe and steady regulated approach.
Yeah, correct.
All right. As we move to wrap this up, Pauli, look at your roadmap. What is the most significant milestone for Real Finance in the next year or so?
Oof. There are a lot of things on our roadmap, to be honest, and our beautiful team is working extremely hard to get new partnerships in. And I can't say much because for some partners we already have some NDAs. But what I can say is like general I think, direction. First of all, two things. Staking will be available soon if it's not yet on our token. And of course, 50 to 100 million worth of assets tokenized in the next 2 to 3 weeks. And I think that the next year and a half is going to be very exciting for the growth spurt for real finance. And I think that our biggest milestone is moving from testing phase to institutional phase. We're going to testnet soon, and mainnet going to be in Q4. So we're going to be focused fully on that. Right now, we have built the engine, and in the next 12, say maybe more months, we want to see the whole car racing on the track. So we're focusing on onboarding several large regulated financial institutions to start tokenizing real world portfolios. And this is a huge deal because it proves that big banks trust our technology enough to use it with real money. And yeah, we're also working hard to make our insurance logic, risk scoring systems fully automated and easy to use. Again, I can't say the names yet with whom we're working on that, but follow our official channels and you will get the news firstly. So yeah, we want just to reach a point where TradFi executive can use our platform and without even realizing they're using a blockchain. So success, I'd say, means to us exactly that technology becomes invisible because it works so smoothly. So I think that by the end of this period, if we survive, we expect to have a pretty vibrant ecosystem full of real assets like houses, loans, businesses, all living on chain.
All right, exciting stuff. Where can people go to learn more, Pauli?
Well, all official links, I think, will be provided under the posts where it is. I'm not sure yet.
Yeah.
But of course, our official channels, which is Twitter, Discord, Telegram, LinkedIn, of course. We have pretty vivid community and incredible community moderators. So if you have any questions, they will respond very in a very urgent manner. And in terms of our docs, they're all on official website. Everything is there. All documents are pretty transparent. We're trying to update them on a daily basis.
All right, and yes, we'll drop the links in the description. Pauli Speaks, Real Finance. Thanks for joining, and thanks everyone for listening. Catch you next week.